Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you joining me here on the East Coast. It's just after 12 noon Eastern Time. I'll say good morning to those of you joining us from the Central Time Zones, the Mountain Time Zones, and the Pacific Time Zones as well. And of course, good evening if anyone's joining us from across the pond in parts of UK or parts of Europe. And good early morning for any of you who are joining us in parts of Australia or Asia as well. Welcome to today's presentation. Let's make a proper protected stock trade. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at RadioActiveTrading.com and at Power Options. Now, what are we going to show today? Well, first, we're going to take a quick review of why you were here and the hidden benefits of stock insurance that we talked about last week. By 12:30, likely sooner, we're going to go ahead and use the tools that I use to pick a proper protected stock position. And we'll post it to our Fusion subscribers at RadioActiveTrading.com. And then I'm going to go through and share with you how this worked, how the stock selection and the proper structure worked over the last 10 or so trades we posted for Fusion subscribers as well. Now, why are you here? Well, maybe you're here to see a stock pick, or maybe you're here because you were invited from an email, didn't have a lot else going on this afternoon. Maybe because you wanted to see more information on selecting stocks, a different approach, or it's maybe because you did not have a good trading year in 2018 and you want to see how you can improve your results. So first, let's just get right down to it. I'm just curious to know, why are you here today? Are you here to see a stock pick using the different tools that are available? Are you here because you were invited? Are you here because you wanted to see more information on stock selection, different structure perhaps, or different criteria? Did you want to see the proper stock insurance? Or are you here because you did not have a good trading year in 2018 and you want to see maybe a little bit different view? I'm only going to leave the poll open for about a minute. I will tell you that there are about 3 or 4 polls total. We'll get 3 of them out of the way right away, go directly into content, and then wrap up with another poll as well towards the end. But that's all you should expect. So they're going to be really quick and rapid. I'm not going to leave them open for more than a minute of our time today. Speaking of which, I'm just at about 1:05 that the poll has been opened. I know we have some more people joining us in the room. Let me go ahead and close the poll. I'm going to share the results with everyone. 30% of you want to see more info on stock selection. 50% want to see the proper stock insurance, a little bit of review of what we did last week, and 13% said that you did not have a good 2018 trading year. I'm sorry to hear that, but I'm pretty sure we're going to be able to help you going into 2019. All right, now let me follow that up very quickly, just so I know. Similar poll from last week's presentation, but I know we have different attendees in today. How was your 2018 trading year? Was it a great year? You had the best return you've seen in the last 5 years? Was it a good year where you maybe met your target goals for yearly returns? Did you have a sort of break-even year, a little bit more, a little bit less than what you expected? Did you have a not good year, meaning that you saw some positive returns, you saw some gains, but maybe in the last 3 or 4 months, really the last 2 to 3 months, you gave all those gains back? And did you have a terrible year? You're way down based on the structure or based on the trading that you were using, and you gave back some of the gains that you possibly saw in 2017, 2016, or beyond. All right, and once again, we're just going to go ahead and close that poll. About 75% of you have voted, but we've had it open for 1:10, and I want to get right to the content. This is a little bit more encouraging than what we saw last week, but still not as encouraging as I'd like to see. Now, 8% of you said that you had a great year. And you had the best returns that you've seen in the last 5 years. That is fantastic. 8% also said that you had a good year. You met your yearly returns. You're still ahead. The majority, unfortunately, of our audience, same as we saw last week, 25% of you were about break even, a little more, a little bit less, didn't reach your trading goals, and 33%, the winner today, but it's not what we'd like to see, is not good. You had some gains, but you gave them back over the last few months. And unfortunately, 25% of you said, terrible. You're way down, and you erased the gains from previous years. Well, I don't like to see that. I definitely think every group is going to get benefit out of this presentation. That's my hope, not necessarily my promise. We'll find out at the end as well. All right. So let's keep those answers in mind. Keep the answers that you gave on those polls in mind as we go through the rest of the presentation. Last week we discussed the hidden benefits of stock insurance, the proper structure that we use in radioactive trading, selecting a put that's far out in time to put time on our side. It's going to leave the upside open on our married put stock and put combination. It's not a throwaway where we just buy a 1 month out cheap put that actually increases our cost basis on an annual basis. We're going to go further out in time to get that lower cost per day. Naturally, we have peace of mind in the proper structure. We know up front exactly what our percentage risk is on the position and the percentage risk on our portfolio, and the proper structure. A little bit different than what you've used to, just buying a 1 month output out of the money or right at the money. Doing the proper structure allows us to manipulate the insurance. It's a second asset that works in our favor that can be manipulated to lower risk, even generate income to lower the cost basis, to get ourselves into a lower risk position than what we originally began. We can better control risk and potentially bulletproof the trade when we cancel all of the underlying risk. And with the proper structure, you can still generate monthly or weekly income as you're doing now in your portfolio, but in a structure that is reducing the risk rather than adding to it. Okay? Well, why is that important? Why is structure important? Again, think about the answers to the earlier polls. What do you feel was the reason that you were not as successful in 2018 as you had hoped? Now, 16% of you had a great year or a good year. You did pretty well. But you can still probably answer these questions as to how you felt, what would have made it better for you. Was it because you felt you picked the wrong underlyings for your securities and for your strategy? Do you feel you just had poor timing when you entered the trade? Do you feel that you had poor timing on management techniques if the stock started to move against you? Or maybe you didn't have any management techniques in mind. Do you feel that you were misinformed about the risks? In other words, you were promised a structure of a trade that could return 3% per month or maybe 2% per week. Heck, even someone offering weekly bull put credit spreads and iron condors that are saying you can make 15% per week. Well, that's possible. It's not a great structure, doesn't have a great probability, but when you take one loss, it's going to wipe out potentially 15 to 20 of the previous gains. Or do you feel your structure was fine? Your management was fine and your timing was fine. It was the market's fault. Or forces outside of the market that dictated the movements of the market itself, especially within the last few weeks, few months, and even earlier in the year as well. Well, we've had our poll open for about a minute. Let me just close that poll and I'll share the results with you. All right, 10% felt you picked the wrong underlyings or the wrong stocks. 30% of you felt you had poor timing when entering the trade. Maybe things looked good. We opened some positions at the beginning of October only to see the market collapse and it drawed everything down with it. Or maybe you're even doing bearish positions and around the 15th or 20th of October you said, yeah, this is a bear market, let me enter a bear spread. And then the beginning of November it came back a little bit before it fell again, but you were still forced to manage. 40% of you, poor timing on the management itself. Now, any structure, any trade, we know that we want to have the ability to manage or adjust positions because not everything's going to go the way we planned, but sometimes we can mistime the management as well. Now, 10% feel that you are misinformed about the risks. You are miseducated about the structure of the trade. And 10%, we're just going to blame the market. Everything we did was right. It worked in 2017. We saw promise for part of 2018, but it didn't pan out, so it was the market's fault. It wasn't our own. All right. Well, that's where we stand, and I promise that's the last poll for probably at least another 45 minutes, maybe less, meaning the webinar might go that long. All right, well, now we know the reasons. More than likely, it was a combination of things, and in that last poll, I did allow you to choose more than one answer. But even with the combination of things, this is why the structure of the trade is so important and beneficial to the portfolio. I'm going to jump over to radioactivetrading.com right now. And what we're going to do is we're going to take a look at one of the little tools that we have here called the Trade Simulator tool. So under Radioactive Trading, just click on the Resources tab up here at the top. See where you can get a free trial to Power Options, but I'm going to go right into this Trade Simulator tool down here at the bottom. This is a simple tool, but in addition to some of the issues we had with discussions on poor timing, maybe poor management timing, or misinformed about the risks on a position, a lot of emphasis does have to be given on the structure of the trade. One of the most popular strategies we know and investors enter is a covered call position. It's the gateway drug, lack of a better term. You apply to trade options at your broker for the first time, they're going to allow you to do covered calls trading on level 1. I really wish they would allow collars and married puts on level 1. A lot don't. They just do covered calls, which I think can get investors into more trouble than it's worth over time. Going 1 month out, looking at an average volatility stock that maybe has good performance, you might expect a return if assigned on your covered call. Let's say buy the stock at 50, sell a 50 strike call for $2. We might expect around a 3% return if assigned on the position. Now it gives us a 3% hedge. 97% of what you're invested in is the stock itself. So you're not going to allow that to happen. You're not going to allow a major unexpected loss to happen. You're probably going to set a stop order at about 7%. So we're going to hopefully try to control any of our losses to 7% or less. Now, you're going to hope you're picking the right stocks. You're going to read some other blog articles. You're going to have some information on fundamentals, technicals, Keltner channels, Bollinger Bands, and so forth. So you think you're going to be right probably at least 70% of the time. 70% of the time you're going to make your 3%. I'm sorry. Probability of loss is only going to be 30%. 70% success rate. 70% of the time you're going to make your 3%. Maybe 30% of the time you take a small loss or you manage the position. Starting with $10,000, maybe opening 2 to 3 trades at a time. Let's just invest 50% into each trade. We could have a winning track record here if we're right 73% of the time. It's about a 10% return over the course of 100 trades. Is that what you were promised with covered calls, that you can make 3% per month and have protection on your positions? With 72%, well, take that up at the end to about 10,773. I'm trying to get to a lower one here. There we go, 69%. You're right just about that 70% of the time, but you're down 8%. You're not meeting your goals for the trade. But the last year, 6 out of the 12 months were negative market performance. In some cases, down as much as 6 or 7% in a 1-month period. Is that going to lead you to a 30% success rate with covered calls, or 70% success rate? Likely it's only going to be maybe a 60 or 55% success rate. 45 losses out of 100 trades. Where's that going to leave you? Well, even at 58 wins, 42 losses, taking that 7% if you're lucky Takes you down almost 50% of your portfolio. It's not the proper structure. Credit spreads, debit spreads, iron condors, really popular structure, something I use in my personal account with only about 10 to 15% of my portfolio. Why? Because of the exposure. So if you look at a 2-week out or 3-week out bull put spread, and you look for a good probability, 75, 80% of expiring worthless. Out of the money, you're still probably generating maybe 20 cents on a 2-point spread, 50 cents on a 5-point spread, which would come out to be a true return on investment of about 11.1%. Well, of course, in a bull put spread, when the market falls, or even in an iron condor, you start to get losses piling up quickly. You only took in 20 to 50 cents of net credit. So if the stock falls a little bit, maybe not even below your strike prices, it might cost you $1.50 to close that spread. We're going to do our best not to allow 100% loss. The stock drops below both strike prices, which makes it almost impossible to manage at that point. So we're going to say we're only going to allow a 50% loss when we're wrong. So on a $2.50 spread, we'd get out with a loss of $1.25. On a 5-point spread, we'd get out a loss at $2.50 with management. But we're going to be right 80% of the time or more. And let's break this up. Let's only do 33% into each trade. Take $10,000, open 3 bull puts or even bear calls, which would have the same structure with that 80% probability. Even if you're right 83% of the time, at one point, you might see a gain of over 50% in a good market. Bull or bear, if the market's going in your direction, several winners in a row, you can build that up to a profitable, let's see, we're about 18 to 20 trades here up at that high point, 50% gain on what we started with. We may have seen a drawdown as much as about 26%. And even with a win ratio of 83%, we're not getting ahead. You actually have to be right closer to 85% or more in this type of structure, with that 80% probability looking for an 11% return in order to profit long term. Here's one at 78%. You had a 10% win ratio at one point, 10% gain on the portfolio, but over time, it's down about 70% of where you started with that $10,000. Okay, so let's try to get to 85. There we go. That's what you're looking for. But with an 80% probability, you need to be right 85% of the time to sort of match those goals that you're expecting. And the drawdown can be atrocious. In order to get that return, you have to stay with the strategy, the leveraged risk. We'd see the same thing with calendar spreads, diagonal or horizontal, butterflies. Even with the higher probability, you need to be right more often than you think in order to profit long term. Now let's go back a little bit. Let's cut down this gain. And let's say we only make about a 6.5% return when we're right. Can't do that with a standard collar. Of course, that's still just a covered call return of 2 or 3%. But let's leave the upside open. Target a return of 6.5% on our winners and control our risk to 4% on the losers. And let's be right only 50% of the time. And because we're buying stock, I'm going to put this back to 50% invested per trade, opening about 2 trades at a time. Here, I could be wrong. I can be wrong more often than right. That's not the goal. But I can be wrong more often than right. And long term, still see a return that matches my target goals for the position, the strategy in my portfolio, without experiencing a heavy drawdown from where I started. Only 10, 15%. That's still too high, in my opinion. I don't want to see that in my portfolio. But it depends on the combination of winners and losers. In 7 trades here, the first 7 trades, we see 1, 2, 3, 4, 5, all right, 6 losses in the first 10 trades to take us down to that 86.73. Well, it's not a great trading record. It's not a great series of combinations in the first 10 trades, is it? That stinks. I'm going to be honest with you. But long term, It is the proper structure to be able to profit in the market. That is the benefit of the properly structured trade compared to other strategies that may have misperformed in 2018, that you may have been misinformed about the risks, knowing that a weekly spread trade, which might generate you an 8% return on a low monetary amount, because you know the risk, right? You know the monetary risk of the difference in strike prices on a credit spread. But if you put in too many contracts, even if you're only doing 4 or 5 contracts, when you take one loss on a leveraged spread trade, could even be a diagonal spread or a vertical spread like a bull put or bear call, even an iron condor, you're probably wiping out 15 to 20 previous gains. Even if you go 3 weeks out in time to get that higher net credit, that looks great. You might be at a 12 or 15% potential return. But one loss is still going to wipe out 8 or 9 previous gains because you looked at that probability of 80 or 85%. And that means you need to be right 90 to 95% of the time in order to profit. We saw looking for that probability of 80% with only a 20% probability of loss. We had to be right 85, 86% of the time in order to meet the goals for that particular strategy. So a lot of it is about the structure. And that's how some of us may have not seen the returns that we wanted for 2018. It's because we weren't in the proper structure for the trade. So we just saw how the most popular structures can get you into trouble, even with a high win ratio. Goals, expectations, and return are not met unless we have just about the perfect trading year. 2017, give or take 1 or 2 little hiccups, might have been a perfect year for bull put spreads, calendar call spreads. Not really iron condors. You didn't want to do the bear call side in 2017 and the second half of 2016. You wanted to leave that open and just do the bull side. Would have worked out fantastically. I had a conversation, a coaching session yesterday where the customer said an interesting point. He said even without proper stock selection, 2016 and 2017 were forgiving, meaning that that proper year during bullish strategies, almost the perfect year if you look at the chart, lower left to upper right, even if you made 1 or 2 mistakes. You didn't get into the stock at the perfect time. You didn't enter the collar, the covered call, the calendar spread, or the debit spread at the exact perfect time. Well, it's forgiving because everything was pushing up. Everything was moving, so you could make some mistakes and it didn't really hurt your portfolio. Now we're seeing something entirely different. It's been an entirely different year, and we don't know what to expect in 2019. That is why the proper structure, controlling the risk on your trade to a known single-digit amount, and forcing yourself into an ideal-sized trade protects you from turbulent markets, the unknown markets. We have a guaranteed exit with the proper structure. The far out in time, married put, set up correctly following the radioactive trading techniques. We have no fear of market trouble, market turmoil, or unexpected events. Sure, we could still lose, but if I only lose 3 or 4% of what I invested in the position, set it up properly to make sure the maximum monetary risk was only 1 or 2% of my total portfolio, I can lose on 5 trades and still have 90% of what I started out with to continue. No fear of earnings, no fear of a poor earnings, but still initial structure set up to take advantage of positive earnings without fear of a negative earnings. And it still puts you in a position where you have ways to adjust if the stock rises, if the stock falls, or even if the stock stagnates in the first 20, 30 to 40 days after you've opened the position, or even sooner. With this structure, it's about a risk of 6% in the worst case scenario, which is typically only hit at expiration if I held the position all the way to expiration, made no adjustments, accepted no dividends. It's probably about 6 to 7%. It avoids the pressure and stress of forced management. The market's down 1.5% today. My stock's down 4%. I need to roll down that covered call to sort of hedge this loss. What happens in the next 3 days if it recovers back up? You've got to buy that call back to avoid getting assigned at a loss, but you're not getting that profit that came back in. You're rolling up for maybe another 1% less loss than you would have taken. A bull put spread, you see a drop of 2.5% in the market or on your stock, maybe 4% on your stock, you're probably now at a 50% loss of the max loss you could have taken. That's probably wiping out 4 or 5 previous gains if you close now. Take the chance and leave it open. Take a higher loss on the position, wipe out more gains. The proper structure avoids the pressure and stress of forced management. You don't feel the need to have a knee-jerk reaction to a market movement, unexpected bad news, or anything globally or politically that comes out to affect the market. All right, so we reviewed the proper structure. We talked about that last week. We just showed the proper structure. We're going to show it again a little bit more in depth. So what stock to select if I'm opening a radioactive trade? Well, in theory, it's any stock, security, or ETF that you're bullish on. Will work for that technique. Blueprint owners also have access to presentations that discuss how to approach it in a bear market as well. But the idea of just picking a bullish stock was forgiving in 2016 and 2017 if you were wrong. In 2018, we didn't see that forgiveness, did we? Based on just the poll results, we did not see that work out too well for other strategies in 2018. So, what do we look for in the stock itself? What do I look for potentially when I'm opening a radioactive trade? Well, I'm going to show you. Here is the basic stock criteria that is used in the Fusion report, the RPM report, and the Fusion subscription at Radioactive Trading for finding a new radioactive trade, and also the Power Options default screen under the Married Put tab. So nothing really advanced. Okay? We're going to look for technicals such as an average stock volume of greater than 300,000 shares on average per day over the last 90 days. We're going to look for some movement. I want to see some volatility, some good volatility. You don't want something necessarily that's safe, too safe. Something with a volatility below 0.15 or 0.12. We typically want to see something that has a volatility of around, let's say, 0.25 or higher. And we're plugging these into the system as a default search. It finds only those positions that match this criteria. I do want stocks in an uptrend. Now, right here, I don't have anything selected for the MACD, but we'll get to that in a moment. A stock price is arbitrary. As a default, we're looking just for stocks between $9 and $200. I don't know your account size, and I personally don't need to know your account size. I'll adjust this based on my needs. If you have a larger account and you don't mind buying stocks, $300, $400, $500 per share, that's fine. You can change that criteria. But as a default, we're starting there as well. In addition to that, I'm going to look for stocks that have a good earnings per share growth. Stocks that have grown at least 5% in earnings from last year to this year. A reflection of good management, good situation, good exposure to the market. I want to see positive growth stocks to help drive the underlying security as well. In addition to that, we do use a preferred stock list of optionable stocks that have worked for us personally, myself, Ernie, Kurt, and other radioactive traders for over the past 10 years. So that's basically what we're doing. Of course, we're looking for the proper structure of the put. It needs to be at least 150 days out in time. I want to keep my risk usually under about 8%. And I don't want to go too deep in the money to hedge myself out of the position. Those are also set in the options criteria. But this is a general starting point of what I'm going to use when I open a position. The tools have already have that programmed in for me, and I can make changes based on my needs. What I'm also going to tend to do, a little bit deeper, is that I'm going to look for a security when I open a new radioactive trade that I feel has the potential to move up about 3 to 6% in the first 20 days. This is not voodoo or hoodoo, just based on a feeling, chart. I'll review the news and so forth, see if there's any pending negative information as well. I'm also going to use the SMA 20. I personally prefer to look for stocks that are above the SMA 20 when I'm entering my positions, in addition to the SMA 50. I like to look for a positive MACD, or a position that's showing just a recent positive MACD trend, and I'd like to see an increasing RSI. This is an older trade from last year. It was Planet Fitness that was bought on August 29th, 2017 for the Fusion subscribers. And you see here, those are the trends that I was looking for when I opened this position. Stock was above the SMA 20, nearing the upper Bollinger Band. Just saw a recent MACD crossover. I know it might be hard to see, but we saw a recent MACD crossover where the MACD crossed above the signal line. And we were seeing an increase in RSI as well towards the end of August going into September. And in the first 20 days, okay, so the stock moved up $2.11, moved up just about, just under 10%. It was about 8.8%. Why is that important? Why am I focusing on this 3 to 6% in the first 20 days? Because that's going to give me the opportunity to do one of the several bullish income methods. And if I'm wrong, I will be wrong. I'm going to show you the results towards the end of the webinar. But if I'm wrong, I still have other alternatives in the radioactive trading techniques to adjust the position, lower the cost basis, lower the risk, generate income even if the stock stagnates or if the stock falls in those first 20 days. Sort of a check mark for me of what I want to see happen and what I'm looking to accomplish on the position. So that's what I look for when I'm opening a new radioactive trade for the underlying security. That's what I'd like to see in the position when I open a trade. But I'm also confident in the structure itself long-term in my portfolio, that even if a position doesn't match the exact criteria, technicals, and fundamentals, it's going to match those fundamental and technical criteria I showed you for the search criteria. Otherwise, it wouldn't pull up in my results. But if it doesn't have the exact MACD, or it doesn't have the exact RSI, I am still confident enough in the structure of the trade to know that I can't get hurt too much, and I'm still going to be able to manage it. So all that saying, I didn't do a lot of preparation. Don't take that as a negative against you. I really want to give you a good presentation. But we're going to go in on the fly. I didn't really look at it this morning. We're going to head over to that RPM report on Fusion and radioactive trading. We're going to see which married puts and radioactive trades are available today that I would enter. But I'm also going to take a look at the default radioactive married put screen on power options. Even if it doesn't 100% match what I want to see, I'm confident enough in the structure that I'm going to go ahead and try to place a trade. And then I'm going to post it to Fusion subscribers. And of course, we're going to talk about it as well. Now, Tom says, does this work for a stock moving down? Well, I'm going to talk about that a little bit later, Tom. There are income methods I can use if a stock is falling to actually stay in the stock and still profit long term. As I mentioned, Blueprint owners have access to previously recorded presentations on playing the protected position in a bear market, not simply just reversing it and doing a married call, shorting the stock and buying a call, but looking at different structures that can work better in that time frame. All right, so let's pause again. I'm going to navigate over to radioactive trading once more. I'm going to show the screen, but this time I'm going to hide the icons there. Here we are still at the Trade Simulator tool. I do encourage you after this webinar to go to radioactive trading, go to the Resources tab, click on the Trade Simulator there, run your numbers for the structure that you were doing in 2018. What was your target goal? What was your loss limit? That again, we talked about in covered calls. Tried to use it with a stop order, but it didn't really work in some cases. I set a 7% stop. The stock falls 15% overnight. I don't get filled at only a 7% loss. I get whatever the market can give me. I take a 15% loss, and that wipes out twice as many previous gains as just taking the 7% loss. But I'm logged in here. I'm going to go to Blueprint and Fusion. Okay, what is the Fusion tools? Fusion is a subscription that helps Blueprint owners better master the radioactive trading techniques, find trades that match what we look for in this structure. And of course, you can follow along with our open trades that Ernie and I have opened. We post, and we also post our income methods and our adjustments there as well. There's other tools to find insurance on the stocks you own with a stock insurance tool, members-only webinars and more, and a series of lessons to help investors master the radioactive trading techniques faster. But I'm just going to go to the Married Puts RPM report. I want to see what new positions come up here for the fusion positions. All right, so we've got 4 that came up. NRG, currently at 41.45, and this I believe is on delayed data. So if I was entering a properly structured radioactive trade, I'd purchase NRG at 41.45, buy the January 45 put for about 690, maybe get a little bit better at midpoint. Total debit would be 48.35 into the position, a risk of 6.9% on the trade. UAL is up there at 88.67, June 90 put, controlled risk of 7.4%. EW, Edwards Life Sciences, 8.7% max risk. And XLNX, still about the same, June 90, same as UAL, almost similar positions, 88.78 versus 88.67. A little bit more expensive put there. 10.05 puts us at 8.9%. What do we see here just on the basic view? All of them have the positive earnings per share growth minimum I was looking for. All of them have the controlled risk as I want. The next step I would do is use the more information button here. I'm going to take a look at the company news, take a look at the chart, of course, to see my other structures, and also the company profile and more if I'm not familiar with the company. All right, now, this is a basic view, and it's a good view, and I can control the number of contracts it's telling me to trade based on I can enter my portfolio size here. You know, it had 100,000 as a default, but I could say, hey, if I have a $50,000 account total, but I'm willing to risk 2% of my total portfolio on the monetary risk of these positions, how many contracts can I trade? Well, 2 contracts of NRG. It's suggesting I shouldn't trade Edwards Life Sciences at 157. And I could do 1 contract, 100 shares in 1 contract apiece of UAL and XLNX. Well, that's great. I'm definitely going to pick one of these 4. But I want to do something first. I know that Edwards Life Sciences for me is already filtered out here because I don't have the funds potentially to trade it. It doesn't make sense to do it following the rules and the radioactive trading techniques with the monetary risk on the position. But I'm going to jump over to power options anyway. I'm going to use the default search in the Married Put view. We're going to look at something very similar. So I'm going to go to the Married Put tab on Power Options now. And I'm going to go ahead and click on the search tool. Now, we do support over 23 different strategies, and the search tool allows you specifically to customize your criteria based on your specific needs. What would I change? Well, I already told you the option criteria. I want to go at least 150 days out in time to put time on my side and have a lower cost per day, rather than buying month by month by month and having a higher annualized return for the put. I can control my risk, and I'm going to do that. My goal is 7.5%, excuse me. Usually about 7.5, 8% is the highest I'm willing to go. And I don't want to go more than 20% in the money. Typically, I don't want to go more than 2 strikes in the money either. Why? I can find a low-risk trade out 300 days, out 150 days, where if I'm buying NRG, say, at $42, I could probably buy a 60-strike put for close to intrinsic value, maybe only 0.5% of time value because it's so deep in the money. It's roughly 50% in the money. But now I'm so hedged out of the position. The expectancy of profit is so low that it doesn't make any sense. Okay. Well, I also talked briefly, we discussed the technicals there, the stock above the SMA 50, and we talked about the fundamentals. And the one thing I might pretty much change is I don't want to see anything above $95. Nothing's there now, but that's what I'm putting in for my account size. I would immediately filter out Edwards Life Sciences. I could look for stocks that just paid a dividend. If I wanted to look for higher market cap, I could do that too. But I'm going to keep it simple because we're already restricted to only 2 or 3 results. Interestingly enough, we just kicked out the other stock, XLNX. And it's probably because the risk jumped above 7.5%. So that's fine. I know this stock right here. Out of all optionable stocks, well, that's an interesting combination, isn't it? Drop me down to June. I don't know if I'm going to stay with that, but in any case, this matches everything I want to see. It's already been done for me, and I just made a couple changes. What is the next thing I'm going to do? I know the stock is in an uptrend. I know it has a positive earnings per share growth. I know it has, this combination has the risk that I want, but I want to go to charts. I'm going to take a look at big charts, just a free resource, and as you can see, I've got my chart set up for about 3 months. I'm looking at the SMA 20 here as my indicators, one of my indicators. So I've got that set. Here we are above the SMA 20. And the Bollinger Band range, it just had a Bollinger Band breakout. That's kind of important to me. And the MACD. Why? Because I want to see that increasing MACD. Now, I agree. I could have been better off if I had opened this position probably 3 to 4 days ago. I'm sorry, beginning of December, 18 days ago. Sure, I see a good growth in the stock here. It pops up well. Hey, from about 39, if I got lucky, to about 42, that's almost a 6% increase in the first 20 days. Exactly what I want to see, and I would have done an income method then. RSI dipped down, but look, it's still increasing. Even though the MACD is starting to pinch, that is a cause for concern. Even though we had a little drop yesterday, it's still matching what I want to see. I'm feeling pretty confident with this one as well. But let's go back. We had another option. UAL in real time, of course. I'm going to go ahead and take a look at that. Let's go to big charts once more. This I don't like. It is above the 50-day moving average, but it's below the 20-day. MACD has been decreasing. RSI has started to move back up. It has been decreasing, but this I don't like. This I don't like. I don't think this is the one I want. So even if NRG is extended, even if maybe I'm a little bit concerned about outside forces, global forces on the natural gas market or other things along those lines, even though one of my trading partners, Greg, who also posts his trade to the Fusion portfolio, is in NRG, I think that's the one I'm going to take. There's something interesting, though. This matches my criteria. 43 strike put, ask of about 440, takes a monetary risk of 270. To keep it under 2% of my total portfolio, I'm probably only doing 100 shares in one put of this one, but we'll see in a second. My max risk is 5.9%. Now, when I had the increase earlier, and I put this up to 8%, it gave me a different one. Right? XLNX is up there too, 7.7%. I was still holding the June at this point. But we saw January 2020. That was interesting. I want to check that out. How am I going to check that out? I see the June here. It has a good risk that I want. But I'm going to click now on Power Options, and I'm going to go to Search by Symbol for NRG. Here's my June series. Here's the one I selected, 5.9% risk. Closer to the money, lower costs is 7.1% risk. That's still good. June 44, 185 days out. That might be a little bit too deep in the money. I prefer to stay a little bit closer. The 42 does look okay. But what happened to that January 2020, 395 days out? Something happened to that 45 strike. Well, it's still there. It's about 6.8% for 395 days. A little deeper in the money. Not too bad of an implied volatility range, which I might look at as well. Pretty good delta. So I can go out 395 days deeper in the money and take a 6.8% risk on my position. Worst case scenario at the option ask. Or I go to June, 185 days, less in the money, but taking about a 6% risk. You can probably already tell where I want to go. I'm going to the January 2020. And the reason why I'm going that far out in time is because I'm gaining 210 days of time. I have to go a little bit deeper in the money, but my risk is only going up 2.5% from the June 45 for an extra 210 days of protection. It's not doubling. It's not tripling. Okay? It's just going up by about 2.5, 2.7%. The June 43 is still really good. That is very attractive. Under 6% risk, 185 days of protection on the position. Has the chart, has the trend. I'd look at the news. But again, I'm so confident in the structure that even if something happens with the natural gas market, I'm going to go ahead and say that's the one I want. Let me take a look at this a little bit more in depth. I'm going to go back to January 2020 from here. I'm taking that 45. It's got an ask of $7 for a risk of just under 7%. Stock's trading, of course, now at 41.35. Now I want to go to the profit and loss chart. Oh, sorry, folks. Let's make sure that's allowed. All right. What are we going to do here? Well, here it shows me that the bid is 660 and the ask is 680. I'm sorry, the ask is 7. Midpoint 680. If I get in at around 41.35 and take that 680, the risk is only 6.5%. Total investment of 48.14. Guaranteed to get 45 back, and that's for 395 days of insurance. And remember, this maximum risk of 6.5% only occurs if I hold the position all the way to expiration, 395 days away. If the stock's still trading below $45 per share, if I make no adjustments, and if I accept no dividends if NRG pays a dividend. Is my break even 48.14? Yes. If I hold the position all the way to expiration, make no adjustments, accept no dividends, that's true. But look here at the halfway point. July 4th, happy Independence Day. July 4th, 2019, even if the stock's just at about $44, $44.50 per share, this put option won't go to zero. It's still retaining a lot of that time value. That's going to help me with the manipulation on the position. So I'm going to go for a nice round number. I'm going to go ahead now. I'm going to pull out my cell phone here. I'm going to look at something else real quick, but I'm going to pull out my cell phone. I'm going to go to my trading app here, and I'm going to put in an order to enter this NRG Married Put, buying the stock, 41.34, buying 2020 January 45 put for about 680. What I'm going to do, though, is I'm going to put my debit cost at a nice round number of 48.15. Okay, now that might change. Let's refresh the page because this is on real time. It's on my Power Options account. I'm going to see if the numbers change here, and I'm going to check one more thing. Still holding at 41.34, 41.35. Midpoint still 680. Just want to check one thing on the put very quickly. I'm going to go to Research, Option Research here. Someone I think just jumped in. Last trade time was 35 seconds ago. Entered at a price. Where's my last trade? So I usually choose last price at 690. Okay, so maybe that's a little bit higher than I want. Mid still 680, but the last trade was at 690. So that's going to be my mark. A little bit more risk than I was thinking about. I'm sorry. We're going to put this in at 690. That's what I'm going to put in. Okay, so let me tap my phone here. Okay. Here we go. Let's go to trade entry. I'm using one thumb and the other thumb here. Kind of confusing for me. I've never done this live. 48.25. That's what I'm putting in for my net debit at 48.25. Stock at 41.34. Put at 690. I'm going to go ahead and add it to my portfolio right now. As a paper trade, I'm going to put it in the radioactive trading positions. Hasn't filled yet. I'm still tapping one thing. Okay, so tap, tap, tap. I'm sorry, there we go. And debit. And 101. I'm only going to do this as 101. All right, so I'm going to try to enter that. Let me widescreen this. Sorry, folks. 690, 41.35. Whoop. 1 and 1 for me personally. So that monetary at risk on the position there it is. I'll let you know if I get filled at a worse price or a different price. Fusion subscribers will probably see that in the next 20 minutes. It is, yes, okay, yes, it is entered now into my trading account from my phone. All right. What did I do? I used the RPM report on Fusion, gave me what I wanted, saw how many shares or contracts I should do if I got in those prices. I came over to Power Options to just verify it, adjust my search criteria slightly. Then I looked at the stock chart, made sure it had the trend that I wanted, made sure I was seeing all the technical indicators that I wanted. Jay just posted, Jay just posted in, said got in at 41.23. All right, so he got in the stock at 41.23, and I guess he's waiting to get filled on the put there as well. Okay, so we had the trend that we want, even though it had a little bit of pullback there. All right, that's where we are. So, what now? Well, I promised we were going to review some other things, didn't we? We just picked the trade. That's what I'm looking to enter. That's what I'm going to see if I get filled on with a price at 690 for the put and the stock at around 41.35 or so. I might have to make an adjustment if the stock moves. I'm not going to check it for the next 20 minutes. Well, until we wrap up, it'll be less than 20 minutes. Now your question is, what's important for you? Other than the fact that I just showed you the proper structure. I took a look at the June that came up and I decided to go in further. I decided to go further out in time. I'll explain why on Thursday when we have our follow-up presentation on is now the right time to do an income method. But am I always right? Did what I show you today, using the default criteria on radioactive trading and power options to help me save time than looking at 2 or 3 other things, am I always right? Well, no, which is why I have the insurance in place to begin with. The market is going to do what it wants. 11% of you did feel that the market was the reason that you were losing. 40% of you felt poor timing and poor management. Hey, even if I got the timing wrong on this trade, I'm still going to go for it. Oh, Jay just said 48.23 is the debit he got filled in. Excellent. We showed you that we used a preferred stock list. Would a better stock list or a different stock list perform better? Would just be focusing on technicals alone, Keltner channels, Fibonacci's, more into Williams percent R, things of that nature, or a different structure? Would that work out better? Well, let's just review the last 3 months. I know it still hurts. The wound is still open. Let's look at SPY, just a broad market indicator. From September 18th to January 18th today, at 11 o'clock, we've essentially seen the closing price of SPY go from $290.91 down to $256.60. That's down $34 or 11.8%. This was poor timing to get into a trade September 5th, September 6th, September 18th, any kind of bullish position. No bull structure would have profited had you continued it over that 3-month period. Bull put credit spreads, especially in October. Diagonal calendar spreads, you'd be down 25 to 30%, if not more, on those bullish positions. Debit spreads even. The iron condor, bear side looking great, bull side's getting hurt. Covered calls. Collars may have been okay. Standard collars may have been okay. You might have reduced the risk, but you would have capped the upside for any potential gains that came through. And they had to roll them or pay more money in to do that as well. Now, I planned for this. Kind of. On September 6th, I opened 3 paper trade portfolios of radioactive positions. Looking at that same proper structure that I use for radioactive trading. I want the risk to be under 7%. I want to be at least 150 days out in time. But on one of those portfolios, I did it just on S&P 5-star stocks. Those stocks rated 5-star buys by Standard & Poor's. On the other one, I looked across the entire market using MACD, increasing RSI compared to positive Keltner channels, I should say, and more. And then third, just took the standard radioactive trading results from the power options search with my subtle limitation of stock price and risk for all 3. Okay, here's the results. Might be hard to see. The S&P combined list on September 6th had us getting into DHI. Well, that didn't work out too well. It's down 18.6%. Oh, the put's countering a lot of that, thank God. But again, down 18.6%. IMAX, down 20. JetBlue Airways, down 12.2. These were the top 4 that matched the criteria. And Owens Illinois Inc., down 7.3%. But I had the proper structure. These are not real trades. This is just a paper trade as an example against S&P 5-star stocks. And as we can see right now, the portfolio is not doing too bad. It's down 1.6%. That includes that decline in October, November, and December with, excuse me, folks, with no adjustments, no income methods. I meant to do this for a blog article, and after the first 20 days, and I sort of got distracted and forgot about it. But for our purposes, this works well. This is how the S&P 5-star list, the top 4 results on September 6th would have turned out. Only a loss of 1.6%. Holding positions that are down 18.6, 20.8, 12.2, and 7.3%. Now this is 1.6 of the total portfolio, not as an average of each position. Okay, that's naturally much higher. But as the total portfolio, because of proper position sizing and just allocating 100 shares in one put, you see that this would be down 1.6%. Okay, so what does that do? Here's open across the market using no preferred stock lists. Looking at the positive MACD, RSI increasing. 4 different stocks, same on September 6th with the same proper structure. KB Home, down 21%. What in the world? Owens and Minor, don't even know what happened here. 61.3% from 1749 to 676. Pilgrim's Pride, down 13.7. Synchrony Financial, 25.1. Proper structure, all 4 negative, but proper structure in the size of the portfolio. Just doing 100 shares in one put to make sure that the monetary risk on any position wasn't more than 1% of the total portfolio. Looking at technicals, MACD cross RSI, Keltner channels, down 1.5% in the 3-month time period. Default radioactive screen on power options. Still all stocks in my range, under $85 per share. Actor International down 25%. Premier down 14.2%. Hey, Planet Fitness up 8.7%. And Starbucks, not the trade I'm in for my Fusion subscribers, but Starbucks up 19.6%. With no income methods, 3-month, same time period, same structure with the stock and put invested, it's up 1%. Is that anything to write home about? No, but that's including no income methods. I could have adjusted any of the positions. Starbucks right now, if I had this, if I was in this trade, with the put out to April, I'd still have insurance out to April, and I can pretty much state that this would be a bulletproof position, guaranteed 5% or 6% return on the position, and probably a liquidation return of, I'm going to say, about 12%. I would have used income method number 4 twice, and I've used a different income method to generate income. I think I'd be at around 11-12% liquidation value right now, bulletproof to the tune of about 5 or 6%, still with 5 months of insurance roughly in place on the position. Planet Fitness would likely be bulletproof or close to it. I would have reduced the risk on these 2 positions by now. Okay, Atcore I would have, I can tell. Premier probably not, but I would have done an adjustment to lower the risk. It's still down 14%. But again, just by looking at the puts there, the April one would have given me a little bit more flexibility than the March, even entered in September, depending, of course, on when this fell. Why am I showing you this? Well, I'm showing you this because this is why we keep these settings. I do review the criteria and compare it. The criteria we're showing on power options and on radioactive trading about every year or at least every 18 months. I check other ideas, subscribers' ideas for stock selection or trade adjustment, different market conditions. But in the end, this is the structure and this is the trading criteria that I look for to select 95% of those trades I post for Fusion subscribers. Okay? But what about individual results? And what about, other than what I just showed, for a 3-month time period? Well, let's go ahead and review very quickly. My last 10 or so trades for the Fusion subscribers. Planet Fitness opened on August 29th, 2017. Applied Materials, end of 2017, October 24th. Sony Corp, January 22nd. Right before what? The February 5th to 9th decline. Interactive Brokers shortly after that February 5th to February 9th volatility decline on February 16th. Pulte Group, sort of home builder there, opened on 4/10, April 10th. Canada Goose Holdings opened on 5/1. Ollie's Bargain Outlets opened on May 3rd. Penn Gaming opened on October 2nd. Starbucks opened on 11/20. Okay. Now, you already saw Planet Fitness. Following that criteria, looking for the MACD that I want and the RSI. In the first 20 days, we saw that already. It was up 8.8%, 2466 to 2477. I'm sorry, 2466 to 2677 in the first 20 days. What is that number 4 in parentheses? I used income method number 4 to cut the risk in half after that movement. AMAT in the first 20 days was from 56.27 at open to 58.80, up 4.3%. Sony, first 20 days, opened on January 22nd, on about January 18th, 19th, 20th, is down to 49.85. Remember what happened from February 5th to 9th. That volatility collapse where the VIX spiked and everything just pulled down drastically. This was during that time frame. It's only down 1.3%. It actually moved up in the first 5 or 6 days, 8 days almost leading to February 5th, and then got pummeled with everything else. Interactive Brokers, from the open at 67.72, and you can see that on the track record there for Fusion, to 72.40, up 6.9%. Income method number 4 was used to cut the risk in half. PHM, 30.02 was the open to 31.17. Not a lot, but it's that 3 to 6% I was looking for in the first 20 days. IM4 was used again. Canada Goose, 36.18 to 41.24, up 14% before earnings. This had nothing to do with earnings. Okay, this was following it up, and I used income method number 4 and 5 prior to the earnings to bulletproof the position, and then boom. Stock wrecked up there at that point, okay? All right. The Penn position. Now here's the peculiar ones in the Stil open. Penn is that interesting position. I opened Penn at $33 per share back on October 2nd. In 2 days, it did move up to $34.72, up 5.2%. But October 5th started that decline. At the 20-day mark or the 30-day mark, it was down to $22.60. 32.6% decline. Well, I held the stock for 10 days. I'm sorry, I held the stock for those full 30 days. With the income methods talked about in the blueprint, I got out for a 10.3% return, and I was long stock the entire time. It did go up as I expected, that 3 to 6% in the first 2 days, but this was a major drop. But it was still a profitable radioactive trade. Ollie did go up 8% on 530 to 66. That was after the earnings, but it was up to $74 before the earnings, still up about 6% in the first 20 days. That stock's now at 66.24. It's down 4 points below where I purchased it in May, but I have a guaranteed almost 5% profit on the position because of the income methods. And Starbucks is the newest trade. I'm essentially 28 days in. It's moved down. Well, I opened the position on November 20th. We know what the market's done since then. So 28 days in, my max loss on that married put, just like the one we were opening, and it get filled on NRG. I'm sorry, lost my train of thought. 6.8% in the worst case scenario. Right now, I'm only at a loss of 1.4%. I can use an income method right now to cut that risk in half. So it's only 3.4% at the max and only 0.7% now. Why am I not doing it? Because I'm going to show it to you on Thursday. we're going to look at the income methods that are available for our newest position we just entered on NRG and for Starbucks as well. So there you have it. That is my approach to stock selection for the radioactive trading techniques. Even if it doesn't meet 100% of what I want for those other technical indicators that I showed on big charts, I'm still confident in the proper structure because I see how it can perform. Using the criteria, we saw how it could have performed in the last 3 devastating months against things such as stocks with other criteria or using technical indicators. Of course, you might have other technical indicators that work better. The idea is that it can work with any bullish structure, any bullish stock based on your criteria selection, but the proper structure is what's really going to save you. Even if you had picked the right stocks for covered call premium, bull put credit spread performance, the last 3 months would have been disastrous. Okay? So what to expect now? For those of you that are Fusion subscribers at Radioactive Trading, you'll see my fill prices on NRG. And if the stock changed a little bit from when I entered it, I might just put it in and what it is now so it doesn't look like I'm making things up and didn't enter a trade right away. Of course, I'm going to post this webinar archive. You'll have that available to you probably around 4 p.m. Eastern time this afternoon for you to review. In the next day, you're also going to see 2 blogs. One review on what we talked about today with the portfolio comparisons, and one comparing against other protected stock structures that I know are being taught out there in the market and what I feel are flaws with them, and you're more than willing, I'd like to encourage you to be more than forthcoming with your arguments against my thoughts on those other protected stock structures. That's how the dialogue keeps going. And then, of course, we'll have a webinar on Thursday. Is it time to do an income method on NRG? It's time to do an income method on Starbucks. I'll do at least one adjustment. I can almost guarantee it. I'm going to guarantee I'm going to do one adjustment on one of those 2 positions on Thursday as well, live. All right. So let's look back one more time. Just remember briefly, what were your 2018 trading year? How was that? Only 8% of you said it was great. 8% of you said it was good. That is very encouraging from what we saw last week. 25% were around break even. 33% not too good, and 25% were terrible. What did we think were the reasons for those results? Well, 10% of you thought you picked the wrong underlyings. Okay, we reviewed a little bit of that today. What worked and hasn't worked for me, and I just showed my last 10 trades. I've been doing that for about 4 or 5 years is what I'm looking for. Poor timing on entering the trade. If you've got the proper structure, even if you didn't pick the exact bottom, you still know you're not that bad off if it goes completely against you. Poor timing on management might have been over managing. Knee-jerk reactions to the sudden market movements or poor news. It might be a problem. That might have been where it was. 10% said you were misinformed about the risks. Well, I'm not going to sit here and try to tell you about returns. So I'm not going to sit here and promise you you're going to make 300% in 6 days or you're going to make 20% on a leveraged spread trade in 10 days. I'm just going to tell you that with the proper structure, you're going to solve most of these problems. And the 10% of you said it's the market's fault. With a proper structure, I can take 4 to 5 losses and still keep 90% of what I had invested in the market. And if I'm right and the market goes up as I was expecting, still going to be looking pretty good on the other side as well. Now, I'm just curious. Did the time you spend with me today, was it beneficial for you? What do you think about what you saw today and what you saw? Are you more confident in stock selection going forward? Do you feel that you see how powerful the Power Options tools are for finding trades, putting in the criteria that you want? Do you feel that the Power Options and Fusion plus the proper structure is going to be a good way to go forward for 2019? Now the blueprint, of course, the full manual that describes all these income methods has a cost of $339. Did you feel the information that you saw today alone was worth the cost of the blueprint, which includes all 12 income methods, the proper setup, and more? Or do you honestly feel, some of you that said you had a great year last year and you exceeded your expectations, maybe none of what you saw today would have helped you? I'd like to know that. So just let me know, of course, what you thought about today's material. Let's see here. All right. Okay, Marvin asks a question. He says, what plan do I sign up for to get all the info you've shown? Obviously, it's not end of day. The Power Options service, when you're on end of day subscription or 20 minutes delayed, will give you access, Marvin, to the default RadioActive screen. Okay? And you'll be able to change the criteria. But the posted trades, my trades, Ernie's trades, the income methods, and more is only available at the Fusion subscription at radioactivetrading.com. Okay? All right. Jay says, how do I register for Thursday? Jay, I'm going to get that post for you. I actually haven't posted yet. It's all written up. I just haven't posted it. You're going to be able to sign up at Power Options or Radioactive Trading, and the invite and link to register for Thursday will be included in the email I'm going to send you when this archive is posted. My mentor, the gentleman you're all familiar with, chimed in here. Kurt went ahead and commented in. He joined us for a little bit. He said, these are awesome, Mike. Losing trades turned into winners. Absolutely. And even the entire portfolio, of course, having a positive gain when the rest of the market was down with the proper structure and the proper criteria that we use. The big losing trades are small. Absolutely. That's why we use the insurance in the first place. And I always thank Kurt for teaching me this 10 years ago as well. Lose nickels and win dimes. Much better than a bull put structure where I can make nickels and dimes maybe 80% of the time, but the 20% of the losses I'm going to be losing dollars and getting behind, where one loss is going to wipe out 10 to 15 previous winners as well. All right, let me close that poll, share the results. As I was talking on there about some of the questions, 25% of you are now more confident in your stock selection. That's great. If nothing else, I gave you a little bit of ideas to go forward in your other trades. 33% of you see how powerful the Power Options tools are for finding the trades and researching and analyzing. 58% of you say Power Options and Fusion plus the proper structure is going to be a great way to go forward. 58% of you feel that this information alone is worth the cost of the blueprint. And that means I did my job, and I thank you for joining me. No one said that none of what you saw today would help you with your trades going forward. Something in today's presentation, any little part of today's presentation would have benefited everyone. So based on that, maybe it is time to change your approach. Head on over to www.radioactivetrading.com/EOY. Right now we're offering that special end-of-year bonuses, the 7 special bonuses for the end-of-year promotion if you pick up the blueprint before December 31st. I'm going to send the link to everyone here in the chat window. It's radioactivetrading.com/EOY. There we go. All right. But act quick because the offer ends December 31st. Now, what are the special bonus offers? If you pick up the blueprint, $339 for the blueprint itself, you're going to get 7 special bonuses. The first one is you're going to be able to follow Fusion. Take advantage of the lessons that are shown, use the RPM report, the stock insurance tool, see Ernie's trades and my trades, and go through the track record. The first 2 months of Fusion are only going to be $10 per month. It's usually $69 per month for the Fusion subscription. You get a $59 discount for the first 2 months. And you don't have to start it right away. You can wait, get your blueprint, and then sign up for Fusion when you're ready, but your first 2 months of Fusion will be $10 per month. We're going to send you one of the Mastery Series videos for free. All right, these are 6 Mastery Series videos that are shown in the home study kit, the blueprint plus the 6 videos that are available. We're going to give you the first one, the Foundations of Radioactive Trading video, for free. You're also going to get 1 month of Power Options, and if you're already a Power Options subscriber and you pick up the blueprint, you're still going to get a month free. It's just going to be put onto your current account, so you might have a January payment for free and so forth. And if you don't have a Power Options subscription, again, you don't have to start that right away. You can wait, get the blueprint, go through the material, follow along with some of the webinars, and then sign up for Power Options when you're ready. You have a full 30 days to use it when you're set. We're going to throw in the quick start guide. Now, this is a white paper that's going to help you eliminate the guesswork about how to transition from the different trades you're doing now into the protected positions, into the proper radioactive trading structure. We're also going to send you an additional video link with a compilation of our most requested replays of preferred webinars. As always, you get email support for free, phone and email support as a Blueprint owner, a Fusion subscriber, or a Power Options member, including the coaching sessions that you can schedule. We're also going to waive the shipping costs. Usually it's about $11 inside the continental US to ship the Blueprint as a full beefy 250-page text contained in a 3-ring binder. It's up to $76 for international orders. Between now and December 31st, we're going to wipe that off. No shipping costs, just $339 for the Blueprint and done. Now what else are you going to get? Well, you're also going to be able to join me for further webinars and the blog education I talked about coming up. The Blueprint comes with a money-back guarantee. You've already answered for yourself how this trading technique could help you going into the next year if you didn't meet your goals this year. You already saw the benefits of protecting it and how it solves the problem of other strategies. But if you pick up the Blueprint, you don't feel confident that it's going to help your trading, or you just maybe feel a little bit different about it once you start going through the material, we don't get a lot of these, but it does have a money-back guarantee. Just send it back to me. We'll refund the cost for your purchase, no questions asked. You can even keep some of the free bonuses as well. And as I mentioned too, you'll also receive several white papers for us going forward from the webinars, some reviews on some of the things we saw today about the performance, about the stock selection, and other information as well. Blueprint owners only webinars starting in January to start helping us go forward into 2019 and much more. But again, it all ends on December 31st, so you want to go to that link, radioactivetrading.com/EOY. You'll see some more information there, and you'll also see a button there that says Send My Blueprint. Just click on that. Go ahead and place your order. Get it done before December 31st. Of course, you can also just click on the products links on RadioActive Trade or in the Power Options store. Questions? You might have some. We've gone a little bit over more than I wanted to today, but if you have any questions, email me at any time, support@radioactivetrading.com. Remember, you can also call us during market hours at 302-992-7971. I'll also get the link posted on radioactivetrading.com and powerop.com to register for Thursday's webinar. That'll be up soon. After I post the fusion trade with my fill prices and check NRG to see where it is, I might post it with different numbers if the stock moved up. If the risk increased, I'll use the current numbers rather than what I got filled on personally. But you'll see the email come out today for registering for the webinar on Thursday, but also to access today's archive. And I encourage you to join me. I encourage you to ask your questions. I encourage you to follow up. But I also encourage you to head over to radioactivetrading.com/EOY. Take a look at those bonus offers again and pick up your Blueprint before December 31st when this offer ends. Ladies and gentlemen, thank you for your time. Thank you for joining me today, and I really hope you got useful information out of today's presentation to help you going forward in whatever we have left in 2018, whatever December is going to show us, and how we're going to start 2019. Hopefully I'll see you Thursday, or I'll hear from you soon via email or by phone. Take care, everyone. Good night.